Hello everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, October 11th, 2025. Hey, how you doing? I appreciate you coming to my weekend review podcast. I hope you're having a good weekend. I hope you had a good trading week last week. Yesterday was quite a surprise. Big down movements in the market, and as we go through the podcast today, I'll be discussing this quite a bit more and what the ramifications are. Spoiler alert, we did change market structure to the downside yesterday, but we'll go over that later in the podcast. So the format for today's podcast is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, all the new entries, any stops, any exits that I have, and then how I am managing the positions that I still have. So basically, when I entered, why I entered, how I set up my stops, how I position size correctly, and then how I'm going to manage the trade going forward. So I have a lot of positions. So if you like watching different entries and how I manage them, today is a good day for you because I do have a lot of them that I entered and exited. But fortunately for me, it was a good week. Always appreciative of that. So after we go through all the trades, we're going to talk a little bit about trader psychology, especially important this week because it supercharged a lot of people's emotions, and so there probably will be more volatility in the week to come. And then after we do trader psychology, we're going to go down through the potential trades that I have for next week. Every Friday night, I go through my master watch list. I take a look at all of the symbols. I go through and I look for potentials that are setting up next week. And what am I looking for? I'm looking for markets that are getting close to certain buy areas and support levels, like order blocks, like major moving averages, low 30 RSI readings, and ideally all of them coming together so we have a confluence, we have a combination. That's what makes the best trades. And I think I've got some good ones. I've got 16 of them on the dailies that we're going to go down through. And a lot of these just haven't been on my radar because it's just been going up and up and up. But now with the sell-off, it's kind of interesting. It gives some potential to get into some of the leading stocks that are on sale. So I'll explain why, go through, and hopefully that's going to be helpful. And if any of this podcast is helpful to you, if you're finding some value in it, I really would appreciate it if you could hit the thumbs up button. Really helps to build the channel, keep the channel around, lets YouTube know there's some valuable content. And if you haven't subscribed, I appreciate if you could subscribe. That would be great as well. So let's go ahead, run the U.S. legal disclaimer. We'll get that out of the way, and then we'll come back and we'll get started. All right, so hang tight for about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started on the daily positions that I have. This is McDonald's. I entered McDonald's on the 9th of October here at 294.30. So first off, why did I enter this trade? So, I use many different trading strategies. This one is simply it's kind of a combination of an order block and a low 30 RSI. But let me first explain what an order block is. This green highlighted area here is an order block. And this order block, the order block is all the way back here, starts all the way back here on 7/24/25. So first of all, what is an order block? And you should really learn about order blocks. They are really a game changer, especially if you add other indicators on top of them. An order block is simply starts. You need to find a swing low. A swing low is a low that has a higher low to the left and a higher low to the right. So this low is lower than here to the left and lower than the next bar to the right. So this is a swing low followed by a swing high. Swing high is just the opposite, has a lower high to the left and the lower high to the right, right? So we have a swing low, we have a swing high, and then we have another swing low that is lower than the first swing low. Okay, so we have a swing low, we have a swing high, we have a lower swing low. Now, the key comes when you have that, nothing's changed, but the key change in the structure of the market comes when that first swing high is taken out. So we have a swing low, we have a swing high, we have a lower swing low, and then here on this day, on the 29th of July, we take out the swing high. This is now where we've changed structure, market structure to the upside. And you can see it sure was. So swing low, swing high, lower swing low, market structure change. Now, as soon as this market structure changes to the upside by taking out that first swing high, now I know where the order block is. The order block is the lowest closing bar prior to market structure change. So the market structure change here, this is the lowest closing bar. The high and the low of this bar is the order block. Now, as soon as that happens, I don't buy this breakout. I just identify where the order block is, the high and the low, and I bring it into the future. So now let's do a thought experiment. If we go into the future here on 9/4 and we are way up this high, could you make a statement that now that you know where the order block was, that smart money was buying here in the order block? When you look here, we're way up here, you look back, yeah, obviously smart money was buying at this time. If you have hindsight, you can look in the past. So does that mean that if it comes back down to this smart money area, because we're just basically an order block as a smart money area, does it mean that it will be smart money the next time if it comes all the way back down there? The answer is maybe, maybe not. But more times than not, the previous smart money area is smart money area again. But not every time, right? That's why we have to set levels and we have to set stops. All right. So again, swing low, swing high, followed by a lower swing low, market structure change. This identifies the order block going into the future. And now I wait for a pullback to that smart money area to buy. So I entered here on the 9th of October because we rejected the bottom of the order block. Here's the low of the green. You can see on the day that I entered it, the price during the day went below, but yet closed back in. That is called a rejection of the bottom of the order block. We can also take it with the rejection of the high of the order block, but on this particular trade, I took it with a rejection of the low of the order block and then it closed back in. Now, in addition to that, my deep dip buy strategy uses 250-day moving average, 200-day moving average, and a 30 RSI. Well, on this particular day that I entered the trade, it almost got to a 30 RSI. We got very, very close. Now, a rejection of the 30 RSI is by itself, standalone, a legitimate entry signal, but I like to have confluence as a signal. So the reason that I took this trade were two. One, we rejected the bottom of the order block and we closed back in. Two, we basically bounced right at the 30 RSI. Okay, so that is the reason for the entry. Now, first thing, right off the bat, and I'll be a little bit more detailed in this particular trade and not so much in the other trades I have, just in the essence of time. But so now, okay, rejection of the bottom of the order block, bounce at the 30 RSI. First thing I have to decide, if I decide to take the trade, is how many shares am I going to buy? Well, this is a very important part of the trade, most important, actually. What I do is very simple. I take 1% of my total trading capital. Let's say I have a $200,000 trading account. 1% is $2,000. If you have a $100,000 trading account, 1%, obviously 100. Works with any amount. So let's say I have a $200,000 trading account times 1% is $2,000. So I take that $2,000. Now I look for the value of the 2 ATR. ATR means average true range. A 1 ATR just means what is the average range that market moves every day, right? I want 2 times that, all right? And here I have my 2 ATR reading, 843. So I take 1% of my total capital divided by, the number now is 843. That tells me I can buy 237 shares, okay? Now, as soon as I see the trade, I do the math, I buy my 237 shares, first thing I do is I take my entry price minus the 2 ATR, right? We just used this number, 843. So my entry price minus 843, that is where I'm going to put my emergency stop. I'm putting my emergency stop exactly 2 ATRs below my entry. So therefore, if I have 273 shares and it moves down 840, what did I do? Okay, I have 237 shares and it moves down $8.43. How much have I lost? I've lost $2,000. I've lost 1% of my account. Now, I always use 2 stops. So if I hit my emergency stop, if it moves down 2 ATRs, I lose $2,000, right? But the good news is that only happens about 5% of the time. The other 95% of the time, if I have a loss on my trade, it will be because of my end of bar stop. Emergency stop's way down there. If I get there, I know I lose 1%. My end of bar stop is going to be much closer, and my end of bar stop is basically the reverse of why I took this trade. Why did I take the trade? I took the trade because it rejected the bottom of the order block. If the next day it had closed below the order block, I'm simply out of the trade for a much, much smaller loss than 1%, right? Even if it closed 1 penny below, I'm just out of the trade for a small loss. And this is the key to trading, everybody, is being patient, waiting for a good setup, having a good risk to reward ratio, so that essentially you're as close to your stop as you can possibly be. So that if you are wrong, you're wrong small. But if you're right, you have the potential for a big move up. And that's trading. Putting yourself in a position where if you're wrong, you can be wrong small, or if you're right, you have the potential for a nice big move up. All right? So, rejection of the order block, the bottom of the order block, bounce at the 30 RSI. I got long, 294.30. I position size based upon what I just told you. Place my emergency stop 2 ATRs below, my end of bar stop, a close below the low of the order block. The next thing I do once I enter the trade is I look for the value of the 1.5 ATR. Right now, the value of the 1.5 ATR is $6.32. Now with this one, I take my entry price and I add 632 to it. So I add the value of the 1.5 ATR to my entry price above my entry price. And this is the orange line. This is my trailing stop mode. This is a level that if I reach, then other rules come into effect. If I reach this 1.5 ATR trailing stop level, now I'm in trailing stop mode. That means in the future, if I have a close below a previous bar's low, I will exit half of my position. So in trading, when you enter and you have a move up and it starts moving your way, you want to tighten everything up, right? When it reaches a certain point, you want to tighten things up so that you don't give it back. And that's what I do with the trailing stop level. If I get to trailing stop mode, now in the future, if I have a close below a previous bar's low, I'm going to get out of half. And that has the effect of just of tightening everything up, because now I have half the position, right? Okay, so rejection of the bottom of the order block, bounce near the 30 RSI, enter 294.30, emergency stop 2 ATRs below, end of bar stop close below the order block, and I place my 1.5 ATR trailing stop level above. So Everything I have talked about so far as stops and trailing stop mode means it's a defensive strategy. If it goes down to my emergency stop, I get out. If it closes below my end of bar stop, I get out. If I get to trailing stop level and I have a close below previous bar's low, I get out of half, right? These are all defensive motions, or in other words, if something goes against me, I take action. But I also like to play offense in my trading, not just defense. These are defensive moves. But I like to play offense, and I do this by taking partial profits each day if the market moves a certain amount from the previous bar's close. And I'll show you exactly because I'm in this trade. So I take the closing price, 297.01. That's the closing price of the day. I now look for the value of the 0.45. The 0.45 is $1.90. So I add the two together, the closing price, 297.01 plus $1.90. That is my first profit target for Tuesday, since the markets close on Monday. 298.91 is my first profit target. And if I hit that profit target, I'm going to put a limit order in the system for Tuesday that says take off 10% of however many shares I have if I hit that first profit target. So if I go into the day with 100 shares, I'll put a limit order at 298.91 for 10 shares. But I do this 3 times every day. So here I show you the first profit target. The way to get the second profit target is just to take the first profit target, again, at the value of the 1.5. I'm sorry, the 0.45. My second profit target for Tuesday is $381. And again, if it gets there, I will sell another 10% of however many shares I went into the day with. If I went into the day with 100, I'm going to sell 10 at the first profit target, 10 at the second profit, and I'll do it one more time. I take the second profit target, $300.81, plus, again, the value of the 0.45, which is $1.90, and that's my third profit target for the day, 302.71. So that's the offensive part of the trading, okay? All right, so now that we've kind of got the building blocks out of the way, let's see how we did, right? Rejection of the bottom of the order block, bounce at the 30 RSI, the reason for the trade, position size correctly based upon the volatility as I showed you, right? Placed my emergency stop how far below my entry? 2 ATRs. Where's my end of our stop? Close below the low of the order block. Place my 1.5 ATR trailing stop level above, and away we go, right? I took the trade. Something's going to happen. I don't know what's going to happen, but I know exactly what I'm going to do regardless of the market happens. If it goes down and closes below the order block, I'm out. If it hits my emergency stop, I'm out. If it moves up, at least the value of the 0.45 ATR, I sell a partial profit. So what happened? Well, it's exactly what happened, right? So we moved up yesterday from my entry, and I hit one profit target. Right? It moved up. The profit target was like $1.90. It moved up 320. So I hit one profit target. I took 10% off. That reduces my position size a little, but I keep the majority to be in the trade, right? So the orange line up here, 1.5 ATR trailing stop level, has not got there, so I'm not in trailing stop mode, but I was very grateful to have this this McDonald's trades go up yesterday after that huge day down. But you know, this is more of a safety stock. It's a consumer defensive stock, so I guess I'm not really surprised. So, but am grateful on such a big down day that this was up. So far, I've only been in it one day. So far, this trade up 0.94%. Again, order block / deep dip buy combination on the strategy. All right, let's go to Netflix. Okay, Netflix has been a really good trade. If you recall, if you watched my podcast last week, I was talking about getting long Netflix for a couple reasons. One, we're in an order block, and this order block starts all the way back here on August 5th. We have a swing low, we have a swing high, we have a lower swing low. We change market structure to the upside. This defines the market or the order block or smart money area. Bring that into the future. If and only if we get back into that order block, I'm going to look to enter Netflix. Okay, well, it did come in the order block, but I was also talking about this swing low here and this swing low here and connecting that swing low to create that megaphone trend line. And what I said was, if we reject that trend line, meaning we were below it and then we closed back above it, that would be a good line in the sand entry to get me into the trade somewhere in the middle of the order block. If I have a 200-day moving average, 300-day moving average, 250-day moving average inside the order block, I can take it inside the order block. Otherwise, normally I wait for rejection of the high of the order block or the low of the order block. So I wanted a line in the sand on the order block. Well, I got that here on this I guess that was Monday, when one, we're in the order block, and two, we rejected, meaning we went below the trend line and we closed back above it. So this is where I entered. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this trend line. So my end of bar stop is pretty close, right? If the next day it would have just closed below, I simply would have gotten out. Okay. So I entered here, 1162.87, emergency stop 2 ATRs below, end of bar stop closed below the trend line. I placed my 1.5 ATR trailing stop level above. This is the orange line. And the next day took off like a rocket ship, hit multiple profit targets. Next day took off again, more profit targets. And now I'm in trailing stop mode. Okay, doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. Next day, up again, more profit targets. Friday, up again earlier in the day where I took off additional profit targets. So now I'm in trailing stop mode. In the future, if I get a close below previous bar's low, I'm going to get out of half, but have not had to do that so far. This trade doing very, very well, up 4.72% for the week. And we'll just see how it goes moving forward. Interestingly enough, I talk about bullish order blocks. Here's the green. Well, this is a bearish order block in the red. Look where we got to. We got right to the bearish order block before it reversed. Interesting, though, right? So anyway, really good trade on Netflix, up 4.72% so far. Okay, BITO. BITO, this is a little bit different type of trade for me. As you've seen, normally I take partial profits. I go into trailing stop mode. But when I enter the trade using an abandoned baby, and I'll explain what that is in a minute, I only have two options on this trade. I place a 2 ATR stop, and I place a 4 ATR profit target. And I let that trade go until either I've lost 2 ATRs or I've made 4 ATRs, right? One of the two is eventually going to happen. So that's why you have the red line here. That's why you have the green line here. So I entered BITO on the 5th of September here at 1923. Why did I do that? Well, you can see the bar that's highlighted in green. The previous day, we gapped down. From the close to the next open, we gapped down. That is bearish. Sentiment is bearish. However, right after we gapped down, the very next day we gap up. Just out of the blue, everything was bearish on the sentiment, followed by extreme move up on the next open. So we went from a bearish sentiment to a bullish sentiment very quickly. That is why it's called an abandoned baby. A gap down followed by a gap up. See how it's kind of down here like an abandoned little baby, right? Now, when this happens, in my experience using abandoned babies, more times than not, when you have a quick down move followed by a quick up move, more times than not in the future, that market should be higher, right? Doesn't have to be, but more times than not it is. So if I'm wrong, I'm willing to, based upon this signal, if I'm wrong, I'm going to be wrong 2 ATR or 1% of my account. If I'm right, I'm going to make twice that and be up 2% in my account, right? So you can see I entered here 193.23. I placed my 2 ATR stop. I placed my 4 ATR profit target. No profit taking anything on this. It started off really good and it went bad, and then we moved up strongly. I was like, wow, we're going to get to that 4 ATR profit target sooner than I thought. But of course, the big down moves last week in Bitcoin. Right now, what did I enter? 1923. It's at 1924. Okay, so it's essentially break even. I'm up a penny. Woo! Right, but this is just a good example of a different strategy that I use with different exit rules. It's just to set it and forget it. I'm going to make 2 ATR, or I'm going to make 4 ATRs, or I'm going to lose 2 ATRs. And that's proper trading. That's asymmetrical risk. If I'm right, I'm going to win more than if I'm wrong. Okay? So basically break even on this trade, up a penny on BITO. All right, let's get on to the next trade. VIX. All right, this is an interesting trade. I did very well on it. And, if you've been watching the podcast, especially last week, I was concerned about the market going down. And the reason why is, here's VIX, VXX. Well, let me take you back here to 9/12. We had a swing low. It was followed by a swing high. We had a lower swing low, and then we broke market structure. Why is that important? Well, it's important because now I know where my bullish order block is. This is highlighted in the green. But if we break a market structure to the upside and then we come back to the order block, what is more likely to happen? It continue down or to continue up? It's more likely that VIX is going to go up. Well, if VIX goes up, what happens to the market? The market goes down. That's why I was concerned about the market going down, because of this formation on VIX. So I entered VIX here on the 7th of October at $33.77. Why? Because it rejected the high of the order block. You see the previous day it closed below the order block, but then it closed back above the order block. That's a rejection of the high of the order block. Okay, so I entered here 337.27. I position size correctly. I placed my emergency stop 2 ATRs below. I placed my trailing stop 1.5 ATRs above. My end of bar stop is simply a close below the low of the order block. So I entered 33.77. The next day it was down. The next day it was down again, but it was still in the order block. But again, this is what was concerning me about the market. VIX had found buyers. VIX had started to consolidate sideways. There were equal amount of buyers and sellers, and that is why it went sideways. So basically, being in an order block, that really concerned me. What kind of got me off of the fence and why I bought VIX on this day, and I don't usually talk about this because a lot of my, my students and people that follow me maybe don't have this indicator, but you can see how my bars are red or blue or green, right? One of the three. So this is similar to an abandoned baby, but when I have a red bar that's immediately followed by a green bar, that improves the quality score of the trade. And what does a red bar mean? What does a green bar mean? A red bar means that MACD is getting lower than its previous bar. And it also means that the trend is in a downtrend. However, if you go from a red bar to a green bar, that means that MACD has now gone above a previous MACD bar's high, and there has been a change in the trend. So when you blue, it's one of the two. Trends down, MACD's doing well, or vice versa. Red means trends down, momentum, the bars are getting less than the previous bar. Okay. Green means trends up, momentum's building. Blue means One's going one way, one's going the other way. Red means both going down. Well, on the previous day, both were going down, followed by both were going up. So whenever I have a red to a green day, that improves the quality score. And if you want to use this on your charts, look for the elder impulse bars. And most trading platforms have it. I don't use this a lot, but I do use it sometimes, and this is one of the reasons. So the reason for the trade was a rejection of the high of the order block plus the red-green on the impulse. Place my emergency stop 2 ATRs below. My end bar stops close below the low of the order block. My 1.5 ATR trailing stop level is above. And then Friday, blast off. Obviously, I got to trailing stop mode, and I hit multiple profit targets. I think I hit 7. So I sold a lot of my VIX into this upward move. Now, RSI is now 64.87. I have a rule that if I ever reach 65 RSI, then the 5 EMA is now my trailing stop. If I close below the 5 EMA, I'm simply going to be out of the trade. So there's a lot of things going on with this trade. Multiple profit targets. I'm already at 65 RSI. It's 64.87, but it was higher during the day. So the 5 EMA comes into play, and I'm in trailing stop mode. And I took a ton of profits into that strength, which I always do, right? So this particular trade has been a monster, and this particular trade, the remaining shares that I have are up 9.98%. Meta. Okay, Meta is very similar to the next Netflix trade, but here we have an order block from the past. I never buy up here. I wait for things to come into the order block. Well, here on the 6th, we clearly rejected this trend line. Remember last week I was saying, look for these two trend lines to be rejected, and it was. I didn't buy this particular day. I think bought something else that day, but the very next day, we again retested the top of the order block, and it was strong enough to close above it. So I entered here 713.07. I placed my emergency stop 2 ATRs below. This particular trade, my stop is going to be halfway of this bar 2 of this V1. A V1 is 2 bars. Bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. Halfway of that up bar of that V1, that you're going to have inherent support there. Okay, and so if my students are listening, they'll understand what I'm talking about. A close below halfway of the bar. So it made sense to me that was going to be my stop, and that's why I drew the green line. Okay, so again, rejection of the high of the order block. Previous day, we rejected that long-term megaphone trend line, which was important to me as well. My end of bar stop, my 2 ATR stop, 2 ATRs below. My end of bar stop, closed below halfway of the washout bar. Place my 1.5 ATR trailing stop level above. Next day, up a little. Nothing to write home about. No profit targets or anything like that. Thursday, up nicely. Up big, right? Hit a profit target. Took some profits off into that strength. Almost got to trailing stop level. We are not there yet. But then, of course, Friday, big down move. It was down big. And so I am underwater on this trade slightly. Let's see. Okay. There we go. I'm down about 1.08% on the trade. Again, I have halfway of the big up bar here inside of the order block. Next week, if it closes below this, if it closes below 701.90, I'm simply out of the trade. Didn't work. Nothing I can do about it, right? I was patient. I waited for the correct entry. Meta is on sale. But if it closes below, I'm wrong. I can't argue with the market. I'm wrong. I'll just get out. I can always get back in. But again, if it does close below and I have to get out, You see, I was good at that. I at least took some profits when the market gave it to me, and it would help mitigate the loss. So this particular trade down 1.08% at the moment. All right, Coca-Cola is an order block combination trade. Most of my trades involve order blocks. So this is an order block from a long time ago. We go all the way back here. My gosh. This order block, strange one, formed on April 7th, 2025. Bringing that order block into the future, this is where I was keying off of my trades. So I entered Coca-Cola here on the 29th of September. Why? Well, this is one of those ones where, again, I'm using that megaphone trend line. We connect this swing low to this swing low. We connect those bottoms. We take the trend line out into the future. If in the future we go down to test that trend line, that is generally a location where the market will have a reaction, and that's exactly what happened. I entered the trade 929 because it was below the trend line and then closed back above. So I entered here 66.03. I position size. I place my emergency stop as always 2 ATRs below. On this particular trade, any close below the trend line would be my end of bar stop. I placed my 1.5 ATR trailing stop level above. And away we go. Next day up for a profit target. Next day up. I can't remember if it was a profit target. Next day down. Next day up. Profit target. Next day down. Next day up. Profit target. Next day down. Just one day up, one day down, one day up, one day down. Thursday, we moved up. And then Friday, yesterday, moved up nicely. Hit 2 profit targets, as a matter of fact. And you can see I finally got to trailing stop level. So now I'm in trailing stop mode. It's high enough for my entry to go into trailing stop mode. And again, just because I'm in trailing stop mode doesn't mean I do anything. It just means that now in the future, if I have a close below a previous bar's low, I'm going to get out of half. So the remaining shares that I have on Coca-Cola, doing decent, up 1.51%. Okay. So just to recap on the current open trades, McDonald's remaining shares up 0.94%. Netflix remaining shares up 4.72%. The BITO abandoned baby trade basically break even. It's up 1 penny, but basically break even. VIX remaining shares on this trade up 9.98%. Meta remaining shares up Meta remaining shares down 1.08%. And Coca-Cola remaining shares up 1.51%. Okay, so those are all the open daily trades that I have. I did close 2 daily trades, and let's go to those now. Okay, I did close out Berkshire Hathaway. Let's first of all decide why I got in and took the trade in the first place. So here we have an order block that was formed on 8/25, swing low, swing high, lower swing low, market structure change, defines the lowest bar close as the bullish order block going into the future. Boom, right? I took the trade here on the 10th of September at 489.46 with the rejection of the high of the order block and the high of the 200-day moving average. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average, giving me a good risk to reward ratio. I placed my trailing stop level 1.5 ATRs above, and away we go. Next day, up, multiple profit targets. Great. Then we headed back down, but we continued to close above the 200-day moving average. There was a profit target here. But the main thing is it kept closing and respecting that 200-day moving average here on the 23rd. Nice day up, profit target, and now I'm in trailing stop mode, right? I don't do anything. I'm just waiting for a close below previous bar's low. Then we kind of have nothing going on here. We have a move up here where I have a profit target, a move up here where I have a profit target. Then we move down. This bar did not close below a previous bar's low. It was close, but it did not, so I did not take any action. Another move up, profit target. Next day, move up, profit target. And then here on the 9th was our first close below a previous bar's low after reaching trailing stop. After reaching trailing stop level, what do? I take off half of the position, right? Those are the rules. And so I took off half the position for a gain of 1.46%. Okay? What happened on Friday? On Friday, I had to exit the entire trade. Why? Because it closed below the 200-day moving average. So the remaining shares that I have on this trade, I lost 0.13%. But was I positive on the trade? Of course I was. Why? For two reasons. One, I took profits when the market gave them to me, right? And then on Thursday, because I was in trailing stop mode, I have a close below the previous bar's low. What did? I took off half the remaining shares for a gain of 1.46%. So I dramatically reduced the amount of shares that I had before the big move down. Make sense? So, but all in all, yes, positive trade, but the remaining shares I had, I closed out on Friday because we closed below the 200-day moving average for a loss of 0.13%. All right, the last daily trade that I exited is CRM. CRM, I had a short on this trade. So I've talked about bullish order blocks. There are such thing as bearish order blocks, and bearish order blocks are just the opposite of what bullish are. We need a swing high, followed by a swing low, followed by a higher swing high, followed by a market structure change to the downside, which happens here. Once that happened, the highest up bar close is now my bearish order block. That is the red section that I moved into the future. Okay, so I shorted CRM here on the 9th of September at 252.04. Why? Because it rejected the 50-day moving average, which was inside the bearish order block. So I position size, I get short, I place my emergency stop 2 ATRs above, and my end of bar stop now is simply a close above this 50-day moving average, the gray line. Because I'm short, I place my 1.5 ATR trailing stop level 1.5 ATRs below. Next day, boom, right off of the bat, I took multiple profit targets to the downside, and I got your trailing stop level. Next day up, so no profit targets. Next day down, profit target. Next day down a little, but no profit targets. Next day down again, continuing to take profits in the direction that I want it to go. Next day, we have our first close above a previous bar's high. So what do? I'm in trailing stop mode because I'm short. I need to buy back half of my shares, and I locked in on half of the shares, 4.04% gain. Then we rally for a few days. This bar here, look, it got above the 50-day moving average, but it closed below, so that kept me in the short. The next day it opened, was above, but it closed below, so I continued with the short, and I took profit targets on this day because it was down. And then we started moving down, more profit targets here, multiple profit targets here, right? So again, I'm taking profits as the market is giving me those profits in the proper direction. And then we rally up again here on this particular day on the 6th. Again, we were way above the 50, but we closed below. It kept me in the trade. The next day down again, I took more profit targets. I finally exited the position here on the 9th because this was the first time it closed above the 50 SMA. And so I exited the rest of with the remaining shares that I had for a gain of 2.71%. So all in all, a really good trade and a good example that you can use order blocks both to the upside and to the downside. This is a bearish order block, so I shorted when it rejected a level inside the bearish order block, and it worked out pretty well. So remaining shares up 2.71%. Okay, so those are all the open daily trades. Those are and the closed daily trades. Let us now go to the weekly charts. I have 4 weekly trades that are currently in process. I like trading weekly charts just as much as I like trading daily charts. They're actually a little less work because you only have to make your buying and selling and execution decisions on Friday because that is when a weekly bar closes. So let's take a look here on the weeklies. Weekly charts here on XLV. All right, so XLV Healthcare Select ETF has been a really, really good trade. This is a combination trade of an order block and a deep dip buy. And let's take a look in the past where that order block formed. The order block formed here on 10/27/23. Why? Because we have a swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change to the upside, which defines the lowest bar close prior to the market changing structure to the upside here. The high and the low of this bar going into the future is the smart money area. And I had been kind of stalking XLV for a long time. And if you've watched this podcast, you remember that when we were in this area, I said, I'm getting ready to buy XLV, but really what I'm looking for is a rejection of the 300-week moving average. This is a deep dip buy approach, a major moving average like the 300 that lives inside the bullish order block, right? I want to improve my chances by having 2 major support levels, an order block and a moving average inside the order block. Well, I waited for months actually for this trade. And, it's a good time to mention. Listen to what I just said. I waited for months to buy this trade. Patience is a huge part of trading, everybody. Waiting for it to get to where you want it to get to and only buying if that happens. Later in the podcast, when I take you through the potential trades for next week, that's what I'm doing. I've identified where I want to buy them, but they're just not there yet. If they get there, great. I'll consider taking the trade. If not, I'm just not going to take the trade. So finally, what I wanted to happen happened here on the 8th of August. We rejected the 300-week moving average, and what else did we do? We closed above the high of the order block. So that's why I took the trade. My entry is $130.07. My emergency stop is 2 ATRs below. My end of bar stop is a close below the 300-week moving average. I placed my 1.5 ATR trailing stop level above. And next week, boom, takeoff. Hit multiple profit targets. Really good start to the trade. Next week, up again. Another profit target. And what else happened? I got to trailing stop mode, which is important, right? All that means now is in the future, if I have a close below previous bar's low, I'm going to get out of half. Okay, so we moved sideways for about a month. Nothing really happened. And then here on the 26th, we have our first close below a previous bar's low. I sell half of the remaining shares that I have. The next week takes off like gangbusters. Again, I sold multiple profit targets into that strength, right? So this week was down a little bit, but the remaining shares that I have on this particular trade currently up 8.57%. So really nice trade, but the real takeaway to this trade, I think, is that I waited for many, many weeks for the market to do exactly what I wanted to do. And look, as soon as I bought it, that's exactly where it took off. So there were a lot of other smart traders that were seeing this happen. And when you have major buy signals on for different reasons, different signals, moving averages, order blocks, that's when the large institutions start getting into those trades. And look what happened ever since that. So it wasn't just me that saw it. There were a lot of other traders that saw that. So remaining shares on XLV on the weekly trade up 8.57%. UUP, Not a lot of people trade the UUP, but it was a good signal, so I took the trade. UUP is the US dollar index. You can see the green box is an order block. You can see we have a 200-week moving average that's living inside the order block. I entered here at 27.21 on 7/11/25. Again, two primary signals. Rejection of the high of the order block, that's one. Close under, close over the 200-week moving average, that is a deep dip buy, so it's combination, order block, deep dip buy. Enter 27.21. My end of bar stop, my emergency stop, 2 ATRs below. My end of bar stop, simply a close below the 200-week moving average. So if I'm wrong, I can be wrong small. I placed my 1.5 ATR trailing stop level above. Next week, up. Next week, we went down. We retested, but closed above the 200, kept me in the trade. Next week, up big. Multiple profit targets. Also got to trailing stop level. And then 2 weeks after that, we have our first close below a previous bar's low. What do? I take off half of the position for a gain of 0.51%. Then we move sideways 4 weeks. This bar here was kind of scary because during the week it was way under, but look where it got to. Got right to the top of the order block and bounced, closed back over the 200. That kept me in the trade. Next week up, profit targets. Next week sideways, nothing burger. This week up again, hit 2 profit targets. So the remaining shares that I have on UUP doing nicely, up 2.44%. It's a big move on a currency. TLT, this trade I've been in 100 years. All right. This trade I have been in since 1/24/25. Can't believe it. One of the longest trades I've ever been in my life. Why did I take the trade? Well, you see the green order block. You see that we reject the high of the order block. I got in the trade at 87.20. Placed my emergency stop 2 ATRs below. Simply my end of bar stop is just a close below the order block. Here, for many weeks, we moved up. I took partial profits into every up move, which was important. We also got to trailing stop mode here on this week back in February. Again, taking profits into this move. Then we had a sideways motion for a few weeks. A big up bar here. Again, selling into all of this strength. Then we had this big collapse in bonds. We have a close below a previous bar's low after reaching trailing stop level. What do I have to do? I have to sell half of my position for a loss of 0.58%. And then after that, we continued down. We had some up bars, we had some down bars, but it never closed below the low of the order block. And then in the last month and a half, we've kind of had some big up moves. Obviously, here I hit a profit target. Here I hit a profit target. This week I hit a profit target. So I've been in this trade for a long, long time. The remaining shares that I have on this weekly trade, up 3.76%. But the one thing about this trade, TLT pays about a 4% dividend. It pays it monthly. So I have been in this for 10 months. So honestly, this has worked out to be a pretty good trade between the capital appreciation on the market itself and the long-term dividends that I've gone on. So the remaining shares up 3.76%. All right, last trade, everybody. Thank goodness. Weekly short trade on Amazon. Okay, you see the red box? That means it's a bearish order block. That means I'm going to be short. Again, what's a bearish order block? It's the opposite of a bullish. We first need a swing high, then we need a swing low, then we need a higher swing high, then we need to change market structure to the downside, which happens, which now defines the highest up bar close before market structure change as the shortable area. So we take the high and the low of the order block, we move it into the future. If we reject the level inside of this order block, which we did, I'm going to get short. The level that I put in this order block was 233.70. Why did I pick this level? It goes back to this bar here on the 7th. We have a big down bar. If you have a big down bar, then in the future, if you rally back up to halfway of that big bar, that halfway of that big down bar, that is where you're going to find inherent resistance. And I know that. And so I have a bearish order block. And then I find another location inside the bearish order block, which there should be resistance at. And that's where I set the level. And that's where I took the trade. I took the trade here on August 15th when this bar rejected that level. The 233.70 level rejected that level. And that's where I got short. So I got short here, 230.90. I placed my emergency stop. I placed my emergency stop 2 ATRs above. My end of bar stop is simply a close above this level. Well, it never did. Look, even before I took the trade, it rejected this level, rejected that level. Here I took it, it rejected the level at 230 when I entered at 230.90. Then for about a month, it just didn't do anything, but it never closed above my level. It tested it 3 more times, couldn't find any more buyers, and now we have moved down from here. So, anyway, have not got to trailing stop level here. However, the trade doing well on the short side, up 6.88%, right? And I have taken some one profit target along the way as well. By the way, earnings are 10:30.25. I never hold through earnings, so regardless of where the stock is right before earnings, I will get out. Whether it's a gain, a loss, break even, doesn't matter. I don't hold through earnings. But Amazon, the remaining shares that I have on this trade on the short side, up 6.88%. So it's been a good trade. So all in all, really good positions here, really good performance. They haven't all been positive, but what I've tried to show you here, and you see the results, is that there are some trades where they're big gains. There are some trades where they're small gains. There are some trades where they're break-even gains, like BITO, almost exactly break-even. And then there's some trades where I have a small loss. That is all acceptable in the realm of trading. Big gains, great. Small gains, great. Break-even trades, great. Small losses, great. What you have to stay away from are the large losses. And if you can do that over time, you're going to be a successful trader. And that's what my results show, right? Because the way that I set up and structure these trades are structured to only allow me those options and not huge losses. All right. So anyway, hopefully that was helpful for you. And before we move on and talk about the potential trades for next week, let's spend a few minutes on trader psychology. Really is the most important skill in trading. So let's do that. All right, everybody. I thought this was a really good post that I saw. I took a snapshot of it, wanted to talk about it. It's funny because I sent this to a couple of my students, and interestingly, they both had the same thought. Take a look at this. Any thoughts that come to mind? Any subliminal thoughts that come to mind? Because 2 completely different students had the exact same thought. Give it a second. What comes to mind? Target and McDonald's. Funny, right? So what you need for in trading, you need focus, you need consistency, and you need discipline. This is what you need, everybody. You do not need some super hot secret holy grail trading system. You need a decent trading approach process that factors in good risk to reward ratios, position sizing, a process, right? And this is what I teach. I do teach private lessons. I'll talk a little bit more about it in the future, but I teach a 20-hour course, and this is what I really try to teach my students. You need focus, you need consistency, and you need discipline. Notice how it doesn't really say anything about a trading approach. There's a lot of good trading approaches out there, but you need to execute on those trading approaches. You need to focus. Your number one priority as a trader, in my opinion, is focusing like a laser beam on your end of bar stops or your emergency stops. Don't get distracted by other things. Focus on the task at hand with the positions that you have. A lot of people somehow kind of like to, I don't know, forget that they have actual positions on, right? That is your main thing. You need to focus. You need to focus on your end of bar stops, your emergency stops. You need to focus every day on the new potential trades that you may be taking that on the dailies or the weeklies. But you need to focus on your process. You need, on the McDonald's side, you need consistency. You are not always going to have winning days. You're not always going to have winning weeks. You are not always going to have winning months. I hate to say it, but it's true. But you need to be consistent in your process. Win or lose every day. Like a laser beam, consistency on taking your partial profits or your stops or exiting the trade. You need to be consistent. Consistency gets it done, right? Not the rabbit, it's the turtle. Slow, meticulous, day after day, rinse and repeat, follow your rules, and if you don't have rules, come to me. Become my student. I will teach you proper rules. I will teach you proper trading. But I could teach those to you, but if you don't do it, what good is it, right? Focus, consistency, and discipline. Well, discipline kind of dovetails into consistency also. You need to be disciplined. It's not fun to take a loss or lock in a loss when your stop loss is, but you need to do it. You need to do the opposite of what everyone else does that loses money. Do they do it? No, they do not. They let their losses run. They cut their winners short. You need to do the opposite. You need to be very impatient with your losses, and you need to be very patient with your winners. You need a process. You need rules to follow. If then statements. If this happens, I'm going to do that. If that happens, I'm going to do this. But there you go, everybody. Focus on what you're supposed to do. Be consistent. Do it every day. And have the discipline to follow your trading plan every single day, regardless of how you're feeling, regardless of what you hear on the news or read on the internet. If you want to be a professional trader, if you want to be a long-term successful, profitable trader, you need this. And by the way, the McDonald's trade that I showed you earlier, this particular post is the reason that I took the trade and a reason that one of my students took the trade, because that was this was the day that I showed him, hey Vivek, how's it going? That's my buddy and my student up in Canada. We both took the trade because of the subliminal McDonald's. I mean, we didn't take it like, oh, it's subliminal by McDonald's. We did it because it was a legitimate entry, right? It's one of the ones I showed you at the beginning of the podcast. But it's funny how both of my students saw Target. Do you buy Target or McDonald's? Okay, well, McDonald's had the setup. So there you go, everybody. What you need: focus, consistency, and discipline. Okay, let's head over and let's talk about the potential trades that I am looking for next week. Like I mentioned, a lot of these stocks have not been on my radar because they've just been overbought. I have not. They just weren't at levels that I wanted to potentially buy them at. But now some of them, big names, are getting there. So that gives us an opportunity. So let's talk about these. Okay, so listen, here I have 16 potential symbols for next week. Theoretically, next week, all 16 of these could trigger on the same day, right? It's possible. Does that mean I'm going to take 16 positions? Absolutely not. I like to take only one trade per day. Even if I have 16 candidates, there is going to, out of those 16 candidates, there's going to be one that's better than the rest. What makes one better than the rest? If I have 16 that all trigger on the same day, how do I narrow it down to one? I give it like a report card. If one stock has one signal, but another stock has two signals, and a third stock has three signals, which one do you think I'm going to pick? I'm going to pick the one that has three, right? So how many signals does it have? What's the risk to reward ratio? There are times where you may have a stock that has 5 signals, but the risk to reward's not good. So I'm not going to take that one. I have to figure that in. I also like to look at the longer term chart. If I'm trading off a daily, I like to look at the weekly chart, right? That may give me some information that improves the quality score of that particular one. If I have a bunch of signals on a daily, but I turn to the weekly, and I have also signals on the weekly, that improves the quality score. If the market's down, excuse me, if the market's down and one of these stocks is up, that's relative strength. I'm going to factor that into it too. So it's important to be able to look at multiple candidates and narrow down to the best entry. And that is what I teach my students. And I talked about this a little bit before, but I have taught students from all over the world. I have taught absolute beginners all the way up to the highest hedge fund levels and everywhere in between. I've been trading for over 30 years. I love to teach. I've turned out some really good traders, like I said, different traders all around the world. I'd love to have you as a student. I will teach you everything I know. I will teach you all the trading strategies that I use step by step, all the rules. We do a lot of simulation trading. And it's important to me that my students succeed. So if you become one of my students, I promise I will give it everything I have. I will teach you everything I know, and you will learn a skill that you can use the rest of your life. And so if you'd like to do that and be one of my one-on-one students, the course is 20 hours. So we'll be spending 20 hours together learning everything. So if that's of interest to you, my email is in the link of this YouTube video. As an alternative to the one-on-one lesson, the 20-hour course is more expensive. It's $2,000. It's the best thing you can do. I promise you, it's worth every single penny. But if finances are an issue, a good place to start as well is my Deep Dip by video course. It's on udemy.com. It's somewhere between $30 and $50. It's 9.5 hours of content. Really, really good. You've seen me use the Deep Dip by here a lot today in the positions that went over. That's a really good, affordable place to start. And if you're interested in that, the Udemy link is in the description as well. So 20-hour course, send me an email. Udemy, the link's in there. But one way or the other, I hope I can teach you some good things to make you a better trader. All right, so let's start with Costco. All right, so Costco obviously is on sale here, right? Big picture, it has gone down quite a bit. Well, Costco on Thursday created a bullish order block, meaning it changed structure from the bearish to bullish. Why? We have a swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change because we took out that swing high. So now the order block is the lowest bar close before market structure change. That's here on the 6th of October. The high and the low of that moving into the future, you can see. I need Costco to come down into this order block. I have identified the area that the key level inside the order block. I don't think I would take a rejection of the high of the order block because that order block's pretty wide. I would certainly take a rejection of the low of the order block. But the level that I like here is 910. Why this level? Here on the 7th, we had a big up bar. If you have a big up bar, halfway of that big up bar is generally, there's generally going to be some support. So we have inherent support of this bar inside a bullish order block, which is bullish by itself. So really what I'm looking for on Costco at the moment, next week, is a rejection of 910 for an order. That 910 would then be my end of our stop. Let's go to Walt Disney. All right, Walt Disney, I have been waiting a long time for Walt Disney. We have an order block that started all the way back here on 5/23/25. Well, I was been waiting and waiting and waiting and waiting and waiting for it to come back into the order block. And it is in the order block. So why didn't I buy it here? Well, ideally, I was looking for it to reject this 200-day moving average. But look, it did not. It was down so much on Friday, it just sliced through it and closed below it. So what are my options at this point? Below here, we have this purple line. This is the 250-day moving average. Now, if next week we reject this 250-day moving average, meaning it goes below and closes back above, I would consider taking it there because my risk to reward ratio is really good. Alternatively, if it goes down and rejects the bottom of the order block, that's also a potential. Now, what about if it goes up? What about if it closes above the 200-day moving average? Okay, that is also a consideration. I may consider that, but the thing that I don't like is that Friday was such a big down bar. It's very likely that if we do go back up, we're going to find some resistance about halfway of this big down bar. So I can't say for sure exactly what I'm going to do. It's in a buyable area. It's in an order block. It has a major moving average, but moving forward from here, a potential rejection of this 250 would be interesting and a potential of the low of the order block of 108.27 would also be interesting. All it does is give a good risk to reward ratio, because if I'm wrong, I can be wrong pretty small. That's the thing. All right, let's go to energy transfer, ET. Well, energy transfer has just gotten massacred, but there is an order block that started back here on the 6th of May. Swing low, swing high, lower swing low, market structure change. Identify the order block going forward. Now, some interesting things here. See how I connected the two swing lows here and here out into time. That gives the destination for that megaphone trend line down here. It's still way below where we're at, right? But it's a megaphone destination trend line that intersects the bullish order block. So, if ET, energy transfer, sometime next week, does continue down into this order block and reject that trend line, I might consider entering there. My stop would then, in the future, would just simply be a close below that trend line. But I think very likely if it does continue down, it will find some support there. And if it rejects it, I will consider taking it because it's a rejection of a long-term trend line, megaphone trend line, inside the order block. I wouldn't just take the trend line because it rejects, or I wouldn't just take the trade based upon the trend line. It has to be inside this order block. And right now, it is inside the order block. So that would be a potential. But my close would be a close below that trend line. Home Depot. Well, Home Depot, I was looking for potential rejection of the 200-day moving average. If you remember, back here on the 2nd of September, we have a 50-day moving average crossing over the 200-day moving average. That is called a golden cross. When you have a golden cross, in my experience, the first pullback to the 200-day moving average after the golden cross usually is a pretty high probability bounce area. Well, we did not close above the 200. So that is, at the moment, not a legitimate signal. What I'm looking for here on Home Depot is this order block that started all the way back July 31st. This is a pretty narrow order block, meaning it's not very tall. So if next week, if we end up rejecting the high of this order block, I would consider taking it. If we end up rejecting the low of the order block, I would consider taking it. And the high of that order block is 730.71. The low of the order block is 364.77. So a rejection of one of those, I would consider taking it. I mean, it's extremely oversold, and we're coming into a previous smart money area. So that's what I'm looking for on Home Depot. Russell 2000. Okay. Well, Russell 2000, first of all, just changed market structure. Why? Swing high, swing low, higher swing high, market structure change. This is now the sellable area up here. I'm talking about getting long down here, but If for some miraculous reason we come back up into this bearish or area, I would be looking for a short there, or at least getting rid of some of my positions, like, because these order blocks are very strong. I don't think it's going to, but who knows? I'm often wrong. But for the purposes of what we're doing here, this is where I'm looking to potentially buy IWM. We'd have to have another big sell-off next week, but it's certainly possible. Why? Swing low, swing high, market structure change. Here is your lowest bar close before market structure change. The high of this order block is 226.38. The low of the order block is 322. The high is 226.38. The low is 223.69. Smart money area, bring the smart money area into the future. Look at that. We have the red line, which is the 100-day moving average inside of this narrow order block. So if we continue down, I don't know if we will, but if we do and we reject that 100-day moving average, I would potentially end up getting long there, because the 100-day moving average, the red line, is a very good line in the sand. It gives me a good risk to reward ratio. If it rejects it and I take it, I stay in as long as it continues to close above the 100. If it closes below, I have to get out. But I like major moving averages inside of order blocks. But again, it's pretty long ways away from there. So the likelihood is low that we would get there. But you have to be prepared that if it does get there, that you know that area is potential. So that's what I'm looking for on IWM, potential rejection of the 100-day moving average inside the order block. And the 100-day moving average at the moment is 225.10. MasterCard, MA. All right, getting pretty close. I kind of like this trade. We have an order block that stems back here from 8/125 into the future. Look what we have. A lot of things going on here with MasterCard. We have an order block. We're inside of it. We have a 200-day moving average that we have almost rejected, or almost gotten to. And again, on the megaphone trend lines, I know I don't usually talk about these because we haven't had them, but now we have them. Look, here's a swing low. Here's another swing low. Connect those swing lows. Bring that trend line out into the future. That is the expected bounce area. That bounce area lines up very nicely with the bottom of the order block and the 200-day moving average. So there should be a big confluence right here. We're almost there. Now, we may just blast down through it, and that's fine. But if it rejects that trend line, rejects that 200-day moving average, I would definitely consider taking MasterCard there. Not because I know it's going to go up from there, but I know it's an important support level that got rejected. And if the next day it just closes down a little, I'm just out. Again, every trade, you don't know if it's going to work, but you have to put yourself into the position where you're very close to your stop. And then if it closes below, okay, get out for small loss. Remember, small losses are allowed. But this one looks pretty good. There's a lot of things going on here. Extended megaphone trend line near the bottom of the order block, 200-day moving average. It's pretty interesting. So we'll see what happens. And that 200 is 555.78, by the way. Microsoft. Been a long time since I talked about buying Microsoft, but here we have an order block. But see how wide it is? I'm not taking a trade at the high of this order block and using the low of the order block as my stop. That's way too far away. But what caught my eye early, again, is this 100-day moving average. The 100-day moving average is at $499.84, so almost $500. Could it come down another $10? 100% it could. But that, again, that would give me a moving average support level inside of an already existing order block. That'd be great. If it rejected, closed above, I would consider taking that trade. Next day closes below by a penny, I'm out. If I'm right and it respects that trend line, has another rally up, okay, there's my risk. There's my good risk to reward. Very small potential risk with potential big reward up. That's what you need. So really about the only thing I'm looking for on Microsoft at this moment is rejection of the 100, which is $499.84. MicroStrategies, MSTR. I was looking at potentially taking this on Friday because it looked like it was going to reject the 300-day moving average inside the order block, but it did not. It closed below. So what are my options at this point? First option would be a rejection of the low of the order block. The low is 317. Or potentially a close back above that 300. Ideally, I like the bottom of the order block. But if we close back above the 300, potentially I could take it. Potentially I could take that as well. But ideally, I'd like a rejection of the low, 317. But we'll see what the price action is and what happens. If we gap down or reverse back up, forming a V1 and the rejection of the 300 inside the bullish order block, okay, that may be a different story. But really, right now, just looking at it, I'm a lot more confident in wanting to buy a rejection of the low at 317. Nike. Oof, Nike, my gosh. Everybody wanted it. Nobody wants it. That was a big day on Nike. Well, we have to go way back here, everybody, to 618.25 to find the next order block. Now, can Nike get all the way down here next week? I don't know. Is it possible? Sure. It sure is. But this is a very low order block. It's a very thin order block, or meaning it's a very low order block. It's not wide. So if we rejected the high of the order block, I may consider getting long there. If we reject the low of the order block, I may consider getting long there. The high of that order block is 60.14. The low is 59.06. I would definitely be buying it on sale if it gets there, but I don't know if it's going to get there. But if it does, I know the level and the rejections that I'm looking for. So make it simple on Nike, a rejection of 60.14, the high of the order block, a rejection of 59.06, the low of the order block. NVDA. When was the last time you heard me talk about NVDA? NVIDIA always goes up. But here I have my level. Order block. Back on 9.5. What do we have living inside the order block? We have a 100-day moving average. Is the 100-day moving average a magic moving average? No. It's just a level. It's a good line in the sand. If next week, if we continue this sell-off and NVIDIA comes down into this order block and rejects this 100-day moving average, I would certainly consider taking it there. If I take it and in the future it closes below, I'm out. If I take it, if it rejects the 100 and I take it and it stays above, I stay in. Follow my process with partial profits and trailing stops and all that. So it's unlikely that it's going to come down here, but it's potential. So the high of that order block is 169.2, the low is 164.06, and the 100-day moving average inside of it is 166.43. Pfizer, PFE. Okay, everybody wanted Pfizer. Nobody wants Pfizer. Unreal. But we have an order block here, and we have a 200-day inside the order block at the top of the order block. Okay, that interests me. It's in an order block, and it's a deep dip by 200-day moving average. So next week, if we reject this 200-day moving average, I will consider getting in the trade and using that 200-day moving average as my level, as my end of our stop. Right now, the 200 is at 24.26. We're at 24.78. Absolutely, next week we could test that, and if it does, I would consider taking that because it's a rejection of a 200-day moving average inside a bullish order block. UNG, natural gas. All right, we have an order block back here, 922. We changed structure, defined the order block. Now, we are in a possible buyable area. Why did I not buy this? Well, I needed to reject the high of the order block, the low of the order block, or some type of major moving average or trend line in the order block, but it has not done that. So moving forward, if we reject the low of the order block, the low of the order block is 12.14. I would potentially enter UNG there. Could I enter it with a close above the high of the order block? I could. The high is 12.51. The low is 12.14. A rejection of either of those would be potential. I'll just have to see. If it gaps up, creates an abandoned baby, and rejects the high of the order block, okay, maybe. But that's what I'm looking for in UNG. Oil, USO. Oof, look at this, everybody. Again, looking for things on sale. This order block back here on the 30th of May, long time ago, the high of the order block 67.25, the low of the order block 65.96. It's a pretty narrow order block. I like narrow order blocks because if they're narrow, I can consider taking a rejection of the high. Always I can consider rejection of the low, but this one, if I get a rejection of the high, certainly. And we could get there, and I would get it on sale. So again, I'm looking to make it simple on this one. Rejection of 67.25 the top, or rejection of the low at 65.96. WES, Western Midstream. This one, pretty close. Look at this. We have an order block that started back here 625. We sliced through the top of it, closed in it, but look, we have a 300-day moving average right now just below it inside the order block. That's an order block deep dip by combination, but I need to see the market reject that level before I do anything, and that 300 is 37.16. So I'm looking for a rejection of 37.16 or a rejection of the low of the order block at 36.72. Walmart, WMT. Well, this is a beauty. I don't know if it's going to get there, but if it does get there, it will get my attention. We have an order block all the way here from 826. We bring that order block into the future. We have a 200-day moving average. This is the black line inside. It's a long ways away. It's unlikely that it will get there, but if it does get there, I think that'd be a pretty good area. But if and only if it rejects the 200-day moving average, and if it rejects it, my end-of-day stop is it closed below the 200. The 200 is 96.01. Last one, everybody. Are you pumped? I am. XLF, which is the Financial Select Sector ETF. We have an order block all the way back here, 613. We bring that order block into the future. We have this 250-day moving average deep dip buy right at the top of the order block. It's a long ways away. I don't know if it's going to get there, but if it does get there, it's an interesting area. So I'll be watching XLF for rejection of the 250, 50, 51. And who knows, but I like to have these things mapped out beforehand, so in the heat of the moment, I'm like, wait, is this right? It's already marked. If it gets there, I know that's a decent potential area with a good risk-to-reward ratio. So anyway, everybody, I know we covered a lot of stuff. If you made it to the end, thank you. You're a hero. But I hope you found today's podcast helpful. If you did, I'd appreciate if you could hit the thumbs up button. I hope you have a good rest of your weekend, your long weekend. Enjoy the holiday on Monday. God willing, I will be here next week and we can take a look. But things changed. Everything changed. Oh, I guess I want to, let me show you that real quick. Sorry, before we go. Let's actually take a look at the indexes. QQQ. Market structure change. Swing high, swing low. Or swing high, swing low, swing high, market structure change. We are in a bearish order block. A bearish order block has formed. If we look at the SPY, big time change of market structure. Doesn't mean we can have rallies from here, but those rallies will probably be sold. On the SPY, for example, we have an order block all the way down here. So if we continue down, this would be a potential area to buy the SPY as well. High 640, low 642.92. So that's what I wanted to leave you off was other than having a good weekend. Remember, the market structure has changed on the indexes. So any rallies we have, in my opinion, more than likely will be short-lived. So keep that in mind. So listen, if you have any questions about what I discussed today, please put them in the comments section. I'll do my best to answer them. Have a good weekend. Try to go out and do one nice thing for another human being today. If we all did that, it would make the world a better place. Try to go out and do one nice thing for an animal each day if you can. They appreciated it just like humans do. So thanks a lot, everybody. Enjoy your weekend and stay safe next week. Take care.
U.S. government Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.